Okay,
Okay.
well, since I can't come to Denver, I thought I'd bring the mountains to you. So this is a picture of the Highland Bowl. Some of you may have had the pleasure of hiking and skiing down there on the left. Today, what I want to do is spend some time with you talking about North America, and particularly, I'm going to focus on liquids today, not so much on gas, but we can get into that later. The reason that we chose liquids is most of the plays right now in the Rockies, and that many of you are playing out of Denver, are more or less oil focused, notwithstanding some of my friends at Antero, et cetera, who are more gas focused. I also want to acknowledge my co-author, Prescott Roach. He's one of our Denver crew, and he'll be around if we have some questions too. So let's take off. We're going to start really with kind of a macro view of what's taking the North American market as well as the overall oil market and shaping that for the future. Then we're going to dive into what we like to call the battle of the basins. And I think you'll have a little fun with that. And we'll finish up talking a little bit about emissions and where we are today and where we're headed. So some of the main themes that are going to drive the market that we'll touch on today really is one is price volatility is going to be here to stay. It will be amplified this year by the economy. Inflation is a key factor of that, but it's not just the U.S. economy. Oil market disruptions, surprises continue to happen. Kazakhstan's the latest one. We still have issues in Libya, Nigeria. Of course, Iran is not moving too fast. COVID also, as it kind of goes through its different life cycles, is also affecting both the markets and the economy. Particularly right now, it's travel and international. So it's the jet fuel that's driving the last bit of supply recovery. And then, of course, supply chain. Those will continue to really cause the volatility in the market for pricing. When we look at the long-term oil supply, there's some interesting things going on there I'll talk about in a second. But one of the key things is that most companies now are focused on the advantaged barrels. And advantaged barrels to us are barrels that not only are the lowest cost from a production operating expense, but lowest cost from a carbon footprint and also lowest cost really when it comes to market. They have a very strong market link. That's driving a lot of behavior in the business right now. Fewer and fewer countries are being, shall we say, explored as well as harvested. And it's also will help set up some additional supply crunches we'll talk about in a second. Another main theme is, of course, this is the era now of capital discipline and the investor. Really, economics 100 when we think about it, but something that maybe we let slip from our emphasis for a couple of years, almost 10 years to be in fact. But now we're in year 2. Some record profits this year are coming our way as many companies spin out of their hedges and oil prices stay high. But of course, the big question is how much longer. M&A, it's really been all about scale and long-term sustainability. You've seen a lot of that happening. We continue to see that again going on this year, but we may start to see something else, and I'll talk about that in a little bit here. And finally, U.S. companies are in some ways focused and also leading emissions reduction. When we think about particularly methane, the U.S. has got really a leadership role there, and we're not bragging about it that much. But it's not just about methane. It's also about the overall carbon footprint. But there is a question of, even if we do go to zero, is that really going to be enough? So with that, let's jump into the macro drivers and really what we call this early stage of energy transition. Energy transitions are usually a 100-year kind of event. And I think we often forget that as well, particularly our politicians. An interesting thing to look at and keep in perspective then on the macro is how fluid is this? This is one of our long-term scenarios for liquids demand. What I want you to focus on, this is in millions of barrels per day over time, is look at the black lines on the top starting at around 2020. So you can see between 2019 and 2021, we have continually been pushing that downward based on our look at all the global factors. We look at about 432 factors to come up with our scenarios. The one that we call our base case is that one that's the darker blue that's called inflections. We believe right now that it'll be the mid 30s when we do see peak demand start to roll over. Notice it's not a steep decline. Now, there is a scenario which we call green rules, where we expedite the shift away from hydrocarbons and we start to see a demand that's no longer, in those 100 range. It's something that really drops off very quickly. And by 2050, we're down to around 60 million barrels a day. Most of us know that forecasting is a very difficult business, so it's probably going to end up somewhere between inflections and the green rules. But it does mean that there's some things we have to do, and we'll talk about that shortly. First one really to think about then is supply. Is there going to be enough supply for that? Well, this is global crude and condensate supply. This is our latest outlook, and what this has in it, color bars on here, are different tranches by break-even points and different types, whether it's conventional or unconventional. That green on there, that dark green at the bottom, that's base production. That's the old conventional production that has been declining at about 4 to 5% per year. Now, if you were to take a green scenario, obviously some of that would get curtailed quicker and we would need more supply. But the big thing that really, as we go on top of that and we start to think about it, the kind of light gray, that's the producing unconventional base. The next color up are the discovered sanctioned projects, so discovered and about to be developed. But the real interesting group really goes from the purple all the way down then right to that sanctioned base. That's all the discovered undeveloped. And that is a huge tranche. More than 30 million barrels.
Bob,
sorry?
Bob, if you don't mind for a second, down at the bottom of the screen where it says stop sharing, could you click the hide button next to it?
Oh, yeah, sorry.
Thank you.
Yep, my apologies. Yeah, so when we start to look at that, then that's a huge amount of supply that right now, when you look at the tranches that take $60 and below to put online, but there are other factors that are there. When we start to look at that, a lot of those are not those so-called advantaged barrels. Some of those things that are in these statistics are fields that were discovered 20 or 30 years ago and probably never will be. Some are like Kalis off in Alaska, right? Way away from any infrastructure. Others are in basins where there's just a lot more things that are lower hanging fruit. So it's very easy to concoct a story where we're going to be short of supply. And that could start happening as you start to look at this graph as early as about 2027, but more likely around 2030. The last tranches on top that are also a big factor are the light blue. That's the unconventionals that we have yet to put online. So those would be places like Australia. Those would be more growth in Argentina. So it's a big unknown as well as we go forward. So there's one thing that's very interesting. We will need new supply. So exploration is far from dead. But when we look at that group, 50% of that is break even at $40. That takes us then to kind of looking at that break-even curve. And here's the break-even curve. The left is the cheapest. So the average points, the average break-even point is that diamond on there. We always show a band because, as most of you know, there's sweet spots and there's a range then between high and low, and that's what we illustrate here with these boxes. you can start to see the different plays. A lot of things on there on an average break even below, as I just showed you on the other slide, below $50. But this is a rank order of really barrels that, as you start to think about the world for advantaged product, are the best ones and the most competitive. Not a surprise, the Middle East is number one, but look what starts to kick in. Brazil, something remarkable has happened there. Break-evens now in some of those deep water are down below $25. And look far on the far right, there's Kazakhstan. What's happening then is the future of supply then, if you kind of look at this, is in a very few number of countries. In fact, really only 10 countries will be the primary focus of any major growth. The United States, it'll be about the Permian. Brazil, it's the offshore. Santos pre-salt. When we think about the others that are on there are Guyana, Kazakhstan a little bit will be contributing, but there's not a lot of places in the world outside of Russia, the U.S., and the Middle East where new supply will come from. That's a bit of a challenge too when we start to think about things. What about the money? Well, here's a graph that shows you in billions of dollars by region what the capex from an E&P standpoint is, and this is upstream only, and what the future will look like. Not a surprise that kind of light blue color on there is North America, by far the largest, and you can see that huge buildup from 2003 to 2015 when we were spending hundreds of millions of dollars in North America alone. We're getting back to a number that will continue to be, when you put offshore Alaska, this has offshore Alaska in it, together with onshore US, we're still looking at something that's just shy of, as we go forward, of $200 billion out of a number that's just shy of 500. So a huge portion, 60% of it, will come from North America. You can see the height of 2014, which was $700 billion globally we were spending money. We don't see us getting back to that probably ever. So it is, again, a reset. So that hopefully gives you an idea of this sort of what's happening in the global macro world. So let's now zoom into the U.S., start to talk about plays in the Rockies and what things will be driving that. So on the left-hand side here, you can see the U.S. crude production forecast built up by play. Millions of barrels a day on the left. And what you can start to see then is the dominance of the Permian. So all those colors, starting with the Wolfcamp Midland, Delaware, Sprayberry, all the way up to the Eagle Ford, which is just above the yellow there, is all the Permian. So 5+ million barrels a day will be coming out of the Permian as we go forward. The Eagle Ford is the purple that sits on top of that. Not a big surprise. We're going to be struggling to keep that at kind of a million as that one really gets on a plateau here. Right above that, the other biggie is the Bakken, which many of you play. The Bakken, again, is a one that more or less we see is kind of peaked on, and it's now plateauing. Layered on top of that, we see the Scoop Stack, a pretty small player. You're talking, a couple 100,000 barrels a day. The Wattenberg Niobrara, though, is a little bigger, right? We're still, and we'll talk about that in detail here in a little bit in the Battle of the Basins, but significantly more when we look at the oil plays. And then just on top of that are things that come from heavy oil and a little bit of liquids from gas. The Gulf of Mexico is the very top, which that surprises some folks. Gulf of Mexico is roughly 2 million barrels a day and will stay on that plateau for a while. Overall, you can see that from 21 forward, we are going to grow again, and we will reach once more by 2024 the height that we did in 2020 and the latter part of 2019 of 12.8 million barrels a day. a huge accomplishment when you think about it. What's driving that? When we look at that, of course, is investment. And the good news about investment, when we look at this middle graph in billions of dollars, that shows you the cash surplus to equity holders or debt holders versus kind of the negative cash that we were seeing. And then the yield per share, kind of an interesting thing, is also shown on here. So the golden era, to kind of answer one of those questions earlier, we think this golden era of cash is going to continue through 2023. And then it'll be up to us and management to see whether through 24 and 26, if we can continue that, or if the graph, as we depict it here, will play out as the truth with things coming back down. Note that cash is going to start to weigh on a lot of balance sheets as far as what to do with it. And we'll come back to that in a little bit later. But you can see 2021, if you look at the spreadsheet to the right, almost $56 billion of surplus cash. We'll see that starting to wind down as we go forward, but also look at the amount of money that's going to equity holders. Not a surprise then. So as capital allocation goes in the future, we're now looking at 60% to 70% of existing cash flow is going back into the business to maintain or do a modest growth, 2 to 3% per year. The rest of that is going towards shareholders and to retiring debt. Most of the U.S. operators should be getting their debt down to 1.5x EBITDA by the end of this year, if they have not already. So the companies will be in the best financial shape that they have been in over 10 years. When we look at that, also one thing you might note too is the rig count. We tend to use money rather than rig count in our forecasts, but you can see we are predicting the rig count to come up this year to almost 780. We're about 560 right now. In 2023, it'll continue to go up. So let's look at the Battle of the Basins now. I've put together, and Prescott and I've kind of put together a look at the Bakken versus the Permian and the Powder River versus the DJ. We thought those were kind of interesting ones to look at. So first off, when we take a peek at the acreage holding and the maturity of the play, these are two maps. The left one is the DJ, the right one is the Powder. The operators are color coded on each map. The color codes are roughly aligned, but there may be some differences between these maps and the next ones that I show you of the companies. But quickly, you can see relatively large positions in both plays. You can also see then quickly that it is a small group of folks that dominate those. Not a surprise to most of you in Denver. It's been that way for a while. But that has a very significant role to play when we start to think about control of the basin. We start to think about who has the best margins. We don't anticipate a lot more M&A then because of those large positions. There'll be some more bolt-ons, but no real significant deals unless we start to see a merger of equals. Where might that be? So here's another way to look at that same lease holding. So the left-hand one, let's start with the DJ Basin on the left and the Powder River will be on the right. But on the left, let's take a look at how to read this graph. So if we take Occidental, petroleum's purple ball over there on the left, Oxy represents 24% of the play. So they're controlling 24% of the production when it goes forward. And for them, as far as their North American onshore goes, that is 30% of their portfolio. So you can see then that we have some pure play guys up on the top. Some of you are on the phone right today. Some of you, those are the privates. Some of those are smaller publics. But pure play operators. The largest one, of course, though, is Savitas, that's up there on the line. Those four big balls are the companies that we call the commercial masters. Every kind of business in the world has 3 to 5 companies that are the commercial masters. They're the ones that control their own destiny. They do that by having the most scale of operations, the most scale of production, and they can go to the suppliers, they can go to the takeaway capacity and do the biggest and best deals. That's why we call them commercial masters. The folks that are down in that kind of far bottom left corner, when we look at things that is not so significant for them or for the play, those are the ones we kind of like to look at often to identify as the potential next M&A takeovers. And the same thing lately, what we've seen a lot of those on the pure play line too have been involved in M&A, and particularly in plays like the Haynesville. When you look at the Powder River, a little different, right? A play that's not as mature as the DJ Basin, one that's just starting, but look at the dominance so far of the activity by EOG. You can also see some of the other big players there, Devon and Chesapeake, and of course, Anschutz. A very different bimodal sort of look when we look at the Bakken and we look at the Permian here in a minute. So what about performance when we look at the two plays? Well, the left is the DJ, right is the Powder again. This is well count on the vertical bar on the left. Production on peak production, per 1,000 lateral feet on a 20-to-1 BOE is the right-hand scale on these. And the way that we can see quickly then, this is just some of the top companies. The play average then, when we look at it, is around 60 barrels BOE per day per 1,000 lateral feet is the play average. And look at that in comparison quickly to Powder River, a little over 90, about 95 over there. So again, you can see that kind of newness of play between the Powder and the DJ, but also a good reason why some of the operators are starting to play in the Powder River. The other thing we can start to see is the inventory. So we split things on a performance basis on quintiles. Red is first quintile, kind of that second. Lighter red is the second quintile. Third is the orange. So you can start to get an idea then of the inventory that's left for the various companies in the core areas. You can also see by this who has the best wells. And not surprising then, some of the folks with the best inventory have the best performance. But there are some of the bigger operators when we look at the DJ and as well as the EO over in the Powder, where you can see the number of wells is a lot different, but you can see that some of them have a much wider range in their portfolio quality as well. What about remaining inventory then? So as we kind of look at that then for the two basins, you can again see DJ on the left, Powder on the right, the difference in the maturity. Powder River, lots of tier 1, tier 2 locations left for some of the key operators that have been drilling a lot. When you look over at the DJ, not so much left of 1 and 2. Now, the good news is oil prices have come up, and that's helping then that a lot of the tier 3s and 4s now are getting to be very economical, and some of them, their performance is coming up to where the tier 1 and 2 used to be 3 and 4 years ago. So let's flip and look at the other two plays. So here's the Bakken, in this case, the Delaware. Same thing, but a lot bigger basins, but also, as you can see from the Bakken and the Delaware, the quilt, if you would, has a lot more players. It's a lot more complex, maybe not quite as set up, in particular in the Delaware as it is in the Bakken. We can see 12 operators more or less are critical and have size, if you would, in the Bakken. It's a little more companies in the Delaware as we go forward. Both these basins do have more room for consolidation and in the future. When we look at that and kind of think about what might happen and who those commercial masters are, again, very similar to those Powder River and DJ slides, this is what we call the play concentration or who matters slides again. So the Bakken on the left, Permian on the right. Very different profiles when we look at it. So Bakken, not a surprise, right? Continental is clearly number one when you look out there, about 15% of the play. Then you go to Hess, then you kind of come Whiting and Conoco. Hess, this is really their only play, as you all know, onshore U.S. right now. A lot of you on the phone fit in that upper left there in the 100%, right? Some privates in particular are part of that. The interesting thing is perhaps when we go down to the bottom of the Bakken, you start to see, besides Conoco, Devon, and Marathon, so there are some companies who contribute a fair amount to the play, but it's not necessarily a significant part of their overall U.S. portfolio. When we look at the Permian on the right, it's even much more of a scatter. And that's why there's a lot more room for consolidation there when we look at it. But you can see that it is driven by Pioneer is the dominant one for sure right now. But when we look at other parts, Conoco, EOG, Exxon, so there's a large group of very large companies in here. Many of these are what we now term super independents. And the way that I define that is a company with 500,000 barrels of oil equivalent and above. There's also in the upper left-hand corner where you see the 100%, a lot of smaller companies. And as you come down sort of in a rainfall in that 3%, a lot of folks who probably will be looked at or be looking at to try to gain the scale to get more competitive. Some clues on who those folks might be, and a little more is looking again at their inventory. So this is the inventory that's remaining. Left-hand side, Bakken, Wolfcamp, Delaware on the right. You can start to see the Bakken. There's not a lot of red left out here. So tiers 1 and 2, not so much left. There is, however, again, once more, when we start to look at that, because of the oil price, a lot of those tier 2s and even some of the 3s now are getting to be economic. The parentheses, a little number on top, that's the remaining years of life of what we call tier 1 and 3. So folks that are less than 3 years or really less than 10 years, one would suspect we're going to do something to try to shore that up. When we look over at the right-hand side in the Wolfcamp, Delaware, those are the remaining locations for those folks, and quite a bit of a different scenario, right? We go through the kind of the top 10 there, a lot of red and orange left, in many cases, a couple thousand locations. In this case, a little different scenario, but this gives you the kind of another way that we look at things in the break even by color. So for tier 1, it only takes $23.60 versus tier 4, it's at $43. So all of them are in the money right now. As far as the top performers, Bakken left, Permian right, and this is overall Permian. When you kind of look at the same thing, the play average, and if you remember where we were for the other two plays, 90 was the average high. When we looked at the Powder, we've jumped up another magnitude here for these two plays. The Bakken is running at about 115. And when we start to look at the Permian overall, we're at 100.25. So quite a significant jump. Not a surprise why some companies are in there. And if you look at the top performers, the folks over on the left side of each of these graphs, a big difference even on top of that, with some of them over 200 barrels of oil equivalent per 1,000 lateral feet. You can see as far as what's going on with the best performers, and then who's inventory wise and how they're driving it. Almost everyone on the left in the Bakken is doing that based on their tier 1 and tier 2. When we look at the Permian, it's a lot more mixed for some of the top performers, but in some ways you might argue that drilling wells that are not in tier 1 and 2 are bringing down their averages too. So how do these plays then, we kind of looked at a little bit then at how the plays are doing on a performance on a BOE per 1,000 feet. Well, what about internal rate of return when we look at things at a $70 oil and $4 Henry Hub? The left-hand side shows you the post-tax IRR. The different color bars, again, are the different quintiles. Real interesting to start to look then at how those plays stack up and why some of the decisions are being made. So the Permian, that's the star. The Eagle Ford is kind of next, and stuff kind of comes down for there. An interesting thing, though, that why I included gas in this for you is look at the Marcellus and the Utica. They're actually their best wells with $4 gas are starting to really be comparative with some of the tier 1 liquid plays. And when we look at the rank order then of break-evens and the plays, and this is a really busy slide, but what you can see on here, the color coding is, so the Niobrara DJ is that kind of dark blue, the orange is the Powder, and the purple on here is the Bakken. So, and this is by operator. I won't go through which operators, won't read those off for you, but what you can see, interestingly enough, is that the break-evens, and these are our dollars per barrel, for the top break-evens really right now are in the Wattenberg play, followed by kind of the Bakken in the new fairway, then the Powder, and then back in. So it's kind of interesting to see how those break-evens vary even between the plays, but also between the operators. When we look at, here's our 70 plus, right? So all of these plays are break even in today's rate. But as you could see from the IRR before, that doesn't necessarily, there's a big change when that happens. So let's finish up and talk a little bit about what's going on in admissions, and first talk about the flaring. And my colleague Prescott has done a lot of work on this, and he's in Denver, so I'm sure he'd be happy to go more detail if anybody wants to. When we compare the Bakken, the Powder, and the DJ over from 2016 to 2022, a couple of things pop out. So gas production, so that's the gas production in the play in green for all of these. The flaring rate, so the flaring rate is a percentage of the total gas production, is that black line. And then in some cases, like in North Dakota, we have the target flaring. So when we look at the Bakken, not a surprise, this tracks activity too, right? So you saw the Bakken flaring go down because there wasn't as much drilling activity, and it popped back up a little bit. But it is right now close to the targets of the North Dakota's state. But look at the competition. The competition really in our book is the DJ. A lot of that is a partnership between the state and the operators, but your flaring has gone down as close to zero as any play that we've seen. The powder is there, but that again, it's the activity. And when you look at the volume there, right, we're less than a BCF a day versus almost a little over 3 BCF a day in the GJ, and pretty close to the same in the Bakken. Not a surprise yet that the powder can be there. When we throw the Permian in here and start to look at that, so this is Permian Texas left, Permian New Mexico right. So think of it as Midland Delaware. You can see a much bigger magnitude, right? We're at 12 BCF a day, and we're at 5 BCF a day over on the right side. But look at the percentages; they're all on their way down to 1%. A massive change has occurred, really, starting the latter half of 2018 and going forward. Not to say that we don't have more to go, but this is something perhaps the industry needs to beat its horn a little bit more. What about the plays then? So if we look at something real interesting, we now have the ability, and I'll show you in a second we have the emissions on every well in North America, pretty much a little over 1.5 million now. And this is CO2. So we're going to switch now from from methane over to CO2. This is CO2 per ton. And this is the average per play. So here's the Bakken, about 10.5. Not a surprise, right? The gas plays are always going to have less. Here's Bone Spring in the Permian. Here's Powder, deep, Powder shallow, Wattenberg. So that's the range of the CO2 per ton that we see by plays. When we go down a little deeper, and this is something this is the first time that we've actually shown this to anyone. This is out of our new impact tool. This is the Bone Spring in purple, Wolfcamp Delaware, Wolfcamp Midland. The Bakken is in this reddish color, and then the Eagle Ford right above it. So when we look at this is in time. So this is the average kilograms per CO2 per EUR over time. You can see it, for example, here in the Bakken, in 2011, it started ramping up, and in 2018, it took a big drop. There's a little bit of an uptick again as we stopped the activity. Bone Spring, just is very lumpy based on the activity, but overall, if you go to 2017, everything is down when we look at it. And when we the final thing I'll show you then is not a surprise, right? The higher volume wells are the lower emitters, right? Because of the average. So this is a map just to show you Midland, Delaware basins, and every one of those dots on there is a well. And the color coding on there shows you their intensity for greenhouse gases or CO2. We can see that over on the right-hand side, the play. So there's the Bone Spring, Delaware, Wolfcamp, Midland. This is color-coded by quintile. So again, you can see the best wells are showing up there or in the bottom left. And this one is even more. So this is by emissions by production size versus CapEx. So again, the best wells are the lowest emitters are the first quintile, second, third, fourth, fifth. And this just shows you over time the amortization per BOE of that whole block. So we're now at a place where on an emission standpoint, we can factor in the advantage barrels based on emissions as well as by their production performance and their overall market access ability as well. So a very exciting place to be, something that will help us as an industry and as individual operators to tell a better story as we go forward and to make investment decisions. So wrapping up then, and we can get to some of the questions going forward, what's next? We still think as I said, the market's going to be very volatile, and that will start to really play havoc a little bit with some of the supply disruptions that we've had, and maybe attenuate some of those. But it's still, just part of life, I guess, anymore for all of us, being flexible and being quick to react, but also make sure that we're the lowest cost producers in the basins, and that we focus on being the best corporate citizens. The second kind of interesting thing is, in the past, we used to think that those supply disruptions were really the governors, as well as investment on U.S. Supply growth. We are starting to worry more about U.S. government policy as a potential governor on U.S. supply. There's a lot of rules and a lot of new things coming up this year that the administration's agenda will continue to hammer away at oil and gas operations, which in particular could make a big difference, particularly methane emissions on stripper wells. Colorado, interestingly, when we look at, and I showed you with those emissions methane charts and flaring, really leads the nation, and particularly the DJ Basin. That's serving a bit as a role model for other states in what an industry regulatory partnership could look like, at least on reducing emissions and carbon footprint. I'm sure there are other areas where some of you would beg to differ, that Colorado is not necessarily a role model. And the final thought then is of this merger of equals. So in many of the basins, as I showed you, the scale and the consolidation has happened amongst the larger companies swallowing up smaller ones. What we think the next one will be this merger of equals. The probable trigger for that is a lower price, below 70, somewhere probably in the 60s. If that happens later this year, then and next year we believe that could trigger the next wave of mergers going forward. So I want to thank you for the time, and I'll look at the questions here and see if we can get a few of those in.
Thanks, Bob. Before we jump to the questions, I just want to thank you, and also thank IHS for allowing you to present this, and also being a platinum member of the Summer Summit sponsorship. If you want, I'll go ahead and just read the questions out loud just so everyone can hear them also. The first one we have is from Tim Rathman. He wants to know how, when you're looking at the remaining inventory by operator, how was the data collected and quantified? Was it based on publicly available data or private data?
Yeah, so all of our, those of you that, I think most of you, probably 95% of you, at least our clients on here, know that we collect all our data from the public. We scrub it, verify it, and then massage it. When we look at remaining inventory by operator, that's a calculated number that we run through. We have our AL and artificial intelligence and ML that we use on the plays. We have the ability right now to basically tell you what every location and potential location in a play, what that production might look like. It's part of our new program and impact called Plan and Produce. And so Tim, reach out to Kathy Meyer or one of us, and we can show you that. But that's how we calculate everything.
Great. Okay. And the next question is from Friso. He wants to know what sources of CO2 are included in the CO2 emissions per well.
Yeah, so the source for those emissions, so as far as the methane emissions, those are, again, it's a calculated proprietary set of information. So we use, again, our database of all the wells that have been drilled. And within that database, we split things into drilling and production. And we add up the methane emissions in those two operations to help us calculate what the emissions for that total well is. And it's proprietary, so I can't really tell you the whole cookbook here, but that's the way that we do that calculation, really.
Do we have any other questions from the audience?
I think there's one out here I see from Tim on the that COGCC has made it hard to get permits to flare. So yeah, absolutely, that's one aspect of why the flaring is down. But I think that's part of the, I guess, in our view, that industry partnership. I know that that's coming in many other states as well, that the flaring will start to go down. But I think the way that we look at it, and the way that those of you that come to CERAWeek, we now have what we call the methane pledge, and we believe that I think most operators are already there. There's some 75 U.S. operators have already pledged to get their methane reduction or methane, emissions down to less than 1% by 2030 at the latest, and some many before that. So that's coming.
Thank you. And then we got a question from Rob Diedrich. He wants to know what is driving the higher emission rates in the Bakken? Is it pipeline capacity or something else?
Yeah. So the intensity. Sorry. That's so some of those higher. The reason that it spiked here recently, of course, was activity picked back up after things stopped. But on an intensity basis, some of it also has to do with that pipeline capacity, but also has to do with older wells too. So there's a lot of things that go into that calculation. And I don't know, Prescott, if you want to say anything more on that, since you're kind of the guru that's been working on that. Okay. If not, if you want to talk more about that, just shoot me a note, or Kathy or Prescott.
Great. Okay. And then we have another question from Rich Botcher. He wants to know, what is the percentage of U.S. oil production coming from stripper wells? And then he says,
the old strippers are about 700,000 barrels a day.
Okay.
So if that gives you in perspective, out of the 11.8 or so. So it's small. So that the interesting thing about it is, if a lot of those are unable to satisfy what potentially could be the new EPA rule, we're going to have to go hunting to replace that supply, right? So instead of growing this year by roughly 800,000 barrels a day of production, we would have to replace some of that. So that would put a significant dent. But of course, it's not all going to happen at once. So it'll probably be over a 3 to 5 year period when those would come off. But that's a significant amount. And of course, the other issue is that's a lot of companies. There's over 10,000 operators in North America, and a lot of those are small independents and that operate stripper wells. Of course, you have them here in Colorado, West Virginia, Pennsylvania have a disproportionate amount, along with Texas, but they're in a lot of places. So it would have a significant effect on employment and things in some areas.
Great, thank you.
Excuse me, Bob. This is Prescott. Sorry for the bit of a delay on your question there. I was having some microphone issues. Just to kind of go back one question to emission rates in the Bakken. I just wanted to address that really quickly. Pipeline capacity is exactly it. So operators have really just been forced to flare pretty significant volumes of gas simply because they can't get that product to market. So, Rob, you're exactly right in that in your question about pipeline constraints.
Great. It looks like we don't have any other questions. Again, we want to thank you, and we want to thank IHS for allowing you to present and also being a sponsor. And thank everyone for attending. We hope you learned something, and we definitely hope on seeing you next month. So thanks again, Bob. It's been great.
Mark, thank you, and thank you, RMAG, for the invite. On behalf of our team at IHS, we really appreciate the partnership. And while we can't meet personally, look forward to seeing all of you again soon. And so do my colleagues in Denver. We still have a big Denver presence, so reach out.
There's a great opportunity.
Thanks so much, everybody. Have a good afternoon.